And good morning, everyone. John Hutchinson with Traders Reserve. Welcome to Breakfast Club this Wednesday, October 8th, 2025. Good set of notes and a stock to share with you today. So let us get to it. Hope everyone is doing well this week. Quick notes. There's some things that caught my eye. The ADP private payrolls report from last week included a revision to August, which means that the private payroll report now has had two consecutive months of its negative jobs, or which essentially is job losses in the private sector. The labor market is one of two cornerstone concerns for Wall Street right now, the other being rate cuts. And the challenge that we have right now is the obviously we're not getting data from the Bureau of Labor Statistics with the government shutdown. So no report for the beginning of October. No end in sight for that shutdown, I think, but maybe that'll change, or maybe it has changed. It's going to start creeping into the stock market at some point. I don't know when, but the general sense for Wall Street over a shutdown is Wall Street's not going to worry about it until Wall Street needs to worry about it. And the point at which they need to worry about it is when that shutdown starts to exceed 4 weeks. Then it starts to become a problem because it creates uncertainty around government-led not economic data, but government-led economics. Now, the one thing to remember about government shutdowns is even though people are essentially furloughed temporarily, they still get paid. So they're not paid immediately, but they're paid on catch up. So there's not going to be a loss of income for people who are furloughed out temporarily because of the government shutdown. But if that shutdown starts to extend beyond the end of October into or even through November, and that's very much the worst case. The reason Wall Street starts to pay attention to that is you're now looking at people, while income is owed to them, they don't have it. And that means that government workers, who are also consumers, have less money to spend. And that starts to weigh on GDP heading into a very important fourth quarter. Um, I I believe that we need to pay a lot of attention to Black Friday and Christmas sales this year as it relates to the health of the consumer. We'll take a look at the stock in a few minutes, but if you saw, I think it was last week, CarMax got thrown off the cliff. Why did CarMax get thrown off the cliff? Consumer delinquencies on car payments. When you start to see excessive pressure in the credit markets and couple that with problems, weakness in the labor market, these are conditions that can lead to a recession. We're not there yet. I could predict a recession, but we're not at that point yet. But when you add on to the loss of momentum this year in the labor market, the inconsistency in income for what is roughly 30% of the economy in the federal government, uh, that will start to have an impact on the stock market. So and on top of that, because why not throw more on top of the fire? We have the Fed meeting at the end of the month, and that meeting will be more important than the September meeting, even though the September meeting is a key quarterly meeting, because the Wall Street will be looking for the Fed to commit to future rate changes, lowered interest rates. And since the last Fed meeting, the tech and small cap markets have had a greater loss of momentum than the Dow or the S&P 500 as a whole, in part because these two markets rely much more heavily on borrowed money, right? Tech is 100% borrowed money. Small caps need many of the small businesses, small caps need loans, and the reduction in the cost of that cap of the borrowed money is critical to the growth in their earnings. So the Fed meeting at the end of this month will bear watching. Markets are again pushing all-time highs again and again and again. Uh, but we're getting a little toppy. So one of the things that I'm watching right now is I would not be surprised to see a short-term correction, 3, 4, 5%. Um, not a collapse, but market needs a breather. It needs a little bit of a reset. So on the bright side, potentially, earnings expectations for next year for 2026 have been increased. It's a small increase from 295 to $299 for the S&P 500, 299 EPS earnings per share for the full S&P 500 for 2026. So that's giving Wall Street a little bit of room to push the market higher. Next week we'll take a look at where the lines in the sand are for the S&P 500. I want to do some data analysis this weekend. But where are the potential tops? Where are the key resistance points up, and where are the key support lines down, so that you can plan ahead. So you have a game plan to play forward. For AI2 insiders, off to a reasonable start. We have 7 positions open. We did cancel 1 position yesterday. We'll talk about that position on the next slide. 2 positions still waiting to enter, which I will update probably tonight after I see the market action from the day. Futures were higher at the open. The Bank of New Zealand cut interest rates, and that helped treasuries and other bond markets, which is giving a little bit of wind in the back of the sails for the stock market this morning. So overall, about a 2% gain in 2 days. That's pretty good considering that Monday was up and Tuesday was down. But we do have a big move projected in one stock today. It's pre-market, so pound of salt with that. We'll see if that actually occurs as the market opens today. But when you see it on the chart, it's just been up, 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 up 5 days in a row. So hopefully we can keep that momentum going in that one stock. And for AI2 insiders, I will let you know later today what that stock is. Probably do another pre-record for you. I'm actually loving the pre-record concept, even though I'm live this morning. But let's keep going. We dodged the bullet in AI2 insiders, and I want to use this as a training mechanism for everyone. The company that we were considering entering was Penguin Solutions. PENG is the stock symbol. And prior to Tuesday, the stock had consistent momentum higher. We could see on the chart in the upper right-hand side, right? Certainly momentum higher, a little bit of a downturn, and then it was pushing forward. So this is the end of the week here, the little red candlestick. Slight gap up, excuse me. Doji candlestick. So I call those spinning tops. Right, they just go round and round and round. Nobody knows which way the market's actually going to go. And when we put out our original plan for the portfolio this week, felt that Penguin still had momentum higher, number one, and that the company would continue moving forward in the stock, but I still wanted to protect. So we put a limit order out for Penguin Solutions, which on the next day, on Monday, sorry, this was the candlestick. All right, that was Friday. This was Monday. We had a very significant gap up move from Friday's close. And so we missed. Our limit order was basically in this range. The stock gaps up. I think the overall finish was about 7%, almost 7% on the day. And so I canceled it. I canceled the limit order. And there were a couple of reasons why I did that. And I don't have it on the chart here, but I'll sort of semi-draw it. It just, remember, it's kind of fake. But the Bollinger Band, I didn't draw that right. Let me clear that and fix that. Just do it a little shorter. Raced up. And it just kind of bisected. So what I was looking at on this, and this is a Marquet Latimer approach. And what I was using the bands for was just a visual confirmation of, was this gap up inside or outside of the band? And it was just outside. And the other key factor for me at that point was that the next day was earnings after the market close. And when I was looking at the stock pre-market, the stock was gapping up again for Tuesday's open. None of that did I like. Now, there's a little theory in earnings for stock traders called the bag holders. And you may not have heard of this one. But the pattern is exactly what you're looking at. The day prior to the earnings announcement, you get this weird gap up move. And the size of this candlestick isn't critical, but it's going to be a green candlestick. It's going to be an up day. And so what it looks like is a stock that's breaking out. Somebody has inside information, because the earnings are coming out the next day. And what happens is retail buyers see the hot stock of the day, right? Up 7%, earnings tomorrow. What if the stock goes up? And I went through all of this with AI2 insiders. If you listened to my video from yesterday, you heard me looking at the earnings, how the stock has moved as much as 10.5% following earnings. And so, I'm in that retail investor mode, fear of missing out. I don't want to miss out on a 10% move, but I also didn't want to pay 10% more than our original entry price. So that was my reasoning and my rationale for canceling the limit order initially. And as you can see, the market opens higher, and then the bag holders get screwed as the stock sold off yesterday before earnings were even announced. Penguin announces earnings. They met EPS, but they missed on revenue, and they guided slightly lower on forward revenue, all of which are negative for this market. And so here we are. The bag holders are now down 20% plus. This is pre-market again. So now the bag holders are left, and we have a massive gap on the chart. It's roughly $5 from here to here, but $8, almost $8 from top down to bottom. So that's what a bag holder is. And I didn't know that Penguin was going to miss earnings. I didn't predict that. But as we start talking more and more about AI2 stocks, and we will, one of the things that we need to pay attention to is, where is the company? How are they positioned? What is their revenue being driven by? And this is a quote from yesterday's earnings release from the CEO of Penguin Solutions, Mark Adams. The emphasis in bold is mine, but the word here that it matters is transformation. And one of the things that I talked about in the AI2 Summit was there are 3 different types of companies in AI2. And I'll share that with you again here in just a minute. And Penguin is one of those companies, but notice they're transforming from something to something, right? Transforming to enterprise AI infrastructure. That means their business is supplying the artificial intelligence infrastructure, chips, servers, data center data center approaches to companies, right? So they are essentially a supplier in between, for example, an NVIDIA and a business. So this transformation is impacting their earnings in the short term. But if you look at so here's the transformation. They sort of marked out around 2022. They said, we're transitioning from this, whatever this was, and transforming to this, right? And this is AI on this side. And so the revenue goes down. But now when you look at the revenue trend, you see the trend is starting to move higher. Okay, it was a little lower in the last in the last quarter. But on a quarter-to-quarter basis, their revenue is trending higher. If we mark out their top line revenue somewhere up here, uh, they're in the middle, right? They're in the middle of the trend. When I say AI2 is still early, right? We're still at the forefront of all of this. This is an excellent example from the revenue side of a company that shows you what I'm talking about. This is what I mean when I say we're early. Companies, right? If Penguin were way up here with their revenue, we wouldn't be having this discussion, and you wouldn't see those two red bars on their chart. But we're not, and it means that we have to pay attention to earnings risks from time to time. You can't always avoid it, and you don't always want to. But the other thing that we did, and I'll just give you a sense of this, write this here in the little bit of writing with mice is very fun. That was our capital allocation. So even if we had bought shares, we'd be down about $100, right? We did not, we didn't put a significant amount of capital into the, or we weren't going to, uh, but we didn't sideline a huge amount of capital. So we minimized our risk on the capital side first and foremost. I knew earnings were coming up, and but I didn't get worried about earnings until that bar, that candlestick right there. And that was when, one, I didn't want to overpay for the stock. So we had a limit order down in the roughly 27 to $28 range. When the stock gapped up, I canceled it because, like I said, I didn't want to pay $30 a share for this stock heading into earnings. So that is one way to look at many of these companies, and one ways that we will continue to look at many of these companies. Excuse me, but this slow rise in revenue is where many of the small caps in AI2, in the AI2 index are. And you need patience. And if you can have that patience, for example, on this chart, this gap is going to fill. It may take 6 months, but I don't know that it will take that much. But you can see, like, $24 was a pretty strong resistance point. I would not be surprised to see this company trade back up to that level. So with that, coming in November, I will be releasing the AI2 Quick Start. This is a focused approach, breaking down what we just did with Penguin Solutions, to identifying and owning top companies in the artificial space. These will not be trade recommendations. It's a better understanding of what these companies are, what they do, where they are in the revenue cycle, sort of a should I own it, should I not? So for AI2 insiders, this will be included with what you already have. But this is going to replace Breakfast Club. I'm making it my mission to educate you and to help put you in front of the best companies, because we're still so early stage. And as I complained about on Monday, everyone has their understanding of artificial intelligence wrong. It's backwards. Um, Companies, and you look at like a Penguin Solutions, they're trying to bring enterprise AI infrastructure to businesses, which takes time. But then on top of that, you have companies trying to learn how to adapt and adopt artificial intelligence. All of that takes time, and it is, and as I said during the summit, it's no different than where we were in the late 1990s with the internet. Nobody knew what the internet could potentially do. And keep in mind, with the internet, even with the internet in the 1990s, the late 1990s, you didn't have mobile phones, you didn't have tablets, you barely had laptop computers at the outset of the internet. Windows computers were still running processors at 486, right? The Intel 486 chip. The growth in chip processing speed is 200 times that today, maybe 2,000 times. I can't do that math that early And I'm not going to go look up my Moore's law computation to figure it out either. But like, remember where we were when the internet first started? Like we were connecting with 16K modems if you had one, right? So this is no different. Companies are still learning how to adopt the infrastructure, the software, the data analysis tools, the people, et cetera. This is why I say we're so early that patience is necessary. And that's why when we do release this AI2 Quick Start, it's to give you that advantage today. And even though some of these companies have been run up simply because they mentioned artificial intelligence, so there will be a period where some of these companies may be overvalued in the short term, but they may still have excellent long-term value. Now, I talked about the three different types of companies. So here they are. Company number one is a company that has two product sets or two service sets. It's something that's old plus artificial intelligence, which is the new. So Microsoft, for example, they have Microsoft Office. That's an old product set. It's not that it's out of date. It's just it is consider it a strong revenue, a strong source of revenue. And at the same time that the company is rolling out new products or services that are specific to artificial intelligence. That's company type number one. Company type number two is like Penguin Solutions, a company transitioning from something to artificial intelligence. That is a very broad spectrum in the artificial intelligence to the AI2 index that I have built. And those are the types of companies where you're going to see a tendency on some of those companies. They're going to miss revenue, they're going to miss earnings. So they're going to be a little more volatile. But that's okay. If we have ways to plan ahead, we can protect and defend ourselves even as we're buying shares of those stock or trading options on those stocks. And the third type of company is pure AI. Lemonade, LMND, that's Larry, Michael, Nancy, David is the stock symbol. That's an artificial intelligence insurance company. Everything they do from buying insurance to claims, to paying claims, is driven by artificial intelligence. That's massive disruption to the insurance industry. It's also massive disruption to labor. And they get great reviews too, by the way. Now, I'm not pitching Lemonade. I'm not telling you go change out your insurance, but they do home, auto, life, pet, the full spectrum of insurance. But it's all driven by artificial intelligence. They still have people working in the background, so it's not like there's zero people. But they're leaning on artificial intelligence, and that's what makes them a pure play artificial intelligence type stock. So those are the three types of companies that we'll be breaking down as part of the new AI2 Quick Start. As we get through the end of October, we will actually, let me take a look at the calendar. I'll give you a kickoff date on that. Will be November 3rd, right after we get done with the Millionaires Trading Club live event. We'll come back, finish out the month, and then kick that off right at the beginning of November. So one of the things, and I apologize, my keyboard went wacky on me, so everything wound up in all caps here. But here's this is the first build of the AI2 index dashboard. I'm completing some revisions because of a new metric. A new metric that I developed, which I've already released, but I'm making some changes to it. And number two, I've found a way to recalculate my old discount model using earnings in three different time frames. And so my old discount model always relied on current year earnings and next year earnings. With data being more widely available, and with me now learning how to code, I can now get earnings data in three different time frames, which is trailing 12 months or TTM, current 12 months, which is the current 4 quarters or the current year, whichever, depending on where the company is in their fiscal year. So if they're at the start of the fiscal year, I can use the current current year's earnings expectations. If they're midstream, I can use the next 4 quarters, and then I can also use 4 quarters in advance of that. So next year's earnings. And what this is giving me is a way to understand PE ratio changes across multiple time frames. So, for example, one of the stocks in our index did something like this. This was an 11, this was a 10, and this was an 8. This was the trailing 12 months. This was the current 12 months, and this was the forward 12 months. It expressed in a PE ratio. When you see a price to earnings ratio declining like that, that tells you that their earnings are rising. And that's a stock I want to own. That means that Wall Street is not prepared for this earnings increase in current stock price. The current stock price would be based on somewhere in between here, right? TTM or current year. Wall Street has not factored in that earnings growth. So that's one of the main changes that I've made here, this earnings assessment in 3 time frames. I have not yet built it into the index. I'm still doing the math and the math validation on how I present that. That would be impacting these 2 little columns here, valuation and GDR. And GDR is a new metric that I've developed which I'm calling the growth to discount ratio. So what it does is it takes all of this data that I just wrote out for you at the top, and then it looks at forward growth rates, which I'll just type in as growth rate. So this is growth rate percent in 1, 3, and 5 year time frames. Now, I'm leaning more heavily on the 1 and 3 year time frames, and a little less on the 5 year. I used to rely strictly on the 5 year, but because there's so much more data available now today, I've been able to modify this and use this in price projection and in developing this ratio. And what this ratio tells me is whether or not I have a stock that I want to own right now or in the near future, because the stock is undervalued relative to future earnings growth. Consider it this way. Let me clear the screen and I'll give you a simple explanation. It's the equivalent of spending $1 to buying $1.50 in earnings, right? That's a good deal, right? You're spending $1, but you're getting the benefit of $1.50 earnings. That is what the growth to discount ratio quantifies. Whether you're spending less for more earnings, right? Or potentially the opposite, whether you're spending more for less earnings, right? So companies where forward earnings are going down, we do not want to spend more money. So that's what this new metric that I've developed will help people to see and understand. And I'm just using words instead of numbers, right? So if a company has an excellent GDR, then that's a company that I want to focus on. That's going to be a company that flows to the top of my scans, my research, my analysis, my stock picks, my long-term stock picks, et cetera. So I'm excited about that. And to give you a quick example of something that we'll be working on as part of the AI2 Quick Start in the near term, let me jump out to a chart and show you a stock that is in the index. This is an old company, right? This is a company that many of you know, Corny. This is an example of old O plus new, which is AI, right? So they have old products, but they're adding in new in the AI space. And based on their chart, they are doing exceptionally well. I mean, look at this. Since the April low, that stock is up 100%. And it's not a stock that a lot of people pay attention to. The other thing that I really like about this, if you're an option seller, you probably we'll take a look at the options chain. I would guess you probably need to be near to the money, but look at the small candlesticks over this, right? This is not a highly volatile stock on a daily basis. This is a stock that back in the day, Michael Schulman used to trade Corning frequently. And as they've now made this transition, now right now I would argue might be, if we look in the lower right, the RSI stock might be a little rich. approaching the 80 level on the RSI 14. But if you look at right there, we have a pretty good line in the sand at 80, right? That was resistance, then support, and then support, resistance and support again, just in that little block. Let me clear it out so you can again get a better sense, right? Just look at this block right there. And you can pretty see the 80 line is a pretty solid line of in the sand for Corning, but this is a company worth looking at. If we look down in the lower left, we have a forward price to earnings ratio of 29. That's 1/3 of its current trailing 12-month price to earnings ratio. But at the same time, EPS this year up 26%. I need to close my drawing for a second and clear my drawings too. Next year, next 5 years, excuse me, next year 17, next 5 years 19. For an old company that used to be in the 8 to 10% range, that's the impact artificial intelligence has the potential to create for Corning, right? A significant increase in their forward earnings per share, their forward EPS. Plus, if you're looking for, hang on, get that off my screen. Thank you. Hey, they pay a dividend too. Is it a big dividend? No, but it's a dividend, and dividend is cash, and cash is king. Concerns, to be fair, relatively lower but flat sales over the last 4 years is so one of the things we would look at, and what we would question is whether this is the transitionary period. Is this the time where Corning is making that transition to incorporate more of the new programs, new partnerships that would have the potential to create that forward revenue growth? They simply haven't yet realized it. And if that's the case, then what's the forward implication on the price? Something else that I'm watching, a metric that I'm keeping my eye on. Don't do that to me. You can still see it. Institutional ownership and institutional transactions. Here in the middle lower part of the screen, way down there. This metric right here, institutional transactions, is keeping me out of a lot of bad trades right now. And I'll tell you why. What I'm able to see, and this is just FinViz, this is like $300 a year, so you can get this too. But what this is telling me is if I see institutional transactions rising, but the stock is doing something like this, right? Relatively flat, right? It's not like that. It's relatively flat. That is quiet accumulation. That is hedge funds, Wall Street banks, Wall Street firms accumulating on the quiet side. They don't want you to know that they are accumulating shares. When I see negative, that is distribution. And that can tip me off to getting out of a trade in advance. This is not a trigger. It is a step in the fundamental analysis process, but it can help you stay out of bad trades if you see this is either small or negative, and the stock has done something like this, right? Might not want to get in right now because institutions have already accumulated. So are they looking for that exit point, right? That's what the negative can tell me. On the positive side, is the stock blasting higher, and are institutions driving that movement higher? So these are some of the things that I'll be teaching in the AI2 Quick Start, this type of analysis and more. So with Corning, let me get this out of my way here. Let's take a quick look at the options chain at $85 a share right now, and even less on the options chain. Today's coffee brought to you by Starbucks Sumatra. I'll go out an extra week. Actually, hang on. Let me check one thing. Earnings, October 28th. So we want to be cognizant of earnings. So if we go out 1 week, just taking a look at something, we'd probably be in okay shape. But one of the things about Corning is actually this isn't all that bad. Anywhere between the 82 and 80 levels for a largely stable stock, but you can see pretty good open interest here at the 80. big open interest at the 75, but you're not getting paid on the put side. So I'm wondering if are people doing a 5 wide on that. But from a spread perspective, the stock trades in 1 point increments. That's $100. Uh, I mean, this is pre-market, so take this for a grain of salt. But there's a near 20% return right there from the 80 to 81, right? A 20 cent difference in credit. So you sell the 81, buy the 80. I'm not making this as a trade recommendation. I'm just showing you this as an example, but that's $100, right? And you're getting $20 on that 100. That's a 1 wide spread. Uh, um, that's a high rate of return, even for a 10-day trade. That would be okay. I mean, you could be more aggressive and do the 2 wide and get a difference of 51 cents, but you're getting a little close to the money. And as I said, the stock chart looks to me like it's getting a little toppy. So I wouldn't want to be too close to the money. But even if you're a single-sided put spread, right here, or even at 78, right, you're getting pretty close to a 0.5% there. Those are reasonable numbers. I mean, at a $78 put, so you got 7,800. If you can get to 40 cents, let me pull up the old calculator. 40 cents. It's a 0.5%, right? That's a 0.5%. That's the old target for near weekly options. Yeah, and with the stock moving higher, pretty good chance of either of those being able to pull those back at a nickel or 10 cents and still pull in a fairly decent premium. So one of the benefits to Corning being an older, slower stock and having smaller bars on the chart is you don't have that high volatility like we saw in a Penguin Solutions or like you can see in a number of other stocks. So I would say, that 80 level is pretty solid. So if you're selling below that, right, that 78, 79 level is right in here on the right-hand side. You're selling right at longer term, not longer term, excuse me, call it 30-day support. So that's reasonable. So that's an example of things that we'll be doing in AI2 index. Let me take a quick look in the chat, see if we have anything. Good morning, everybody. Thanks. Key difference between the momentum portfolio and the weekly 10. The weekly 10 is Jeff's. That's just taking a look at stocks that are on the move in the week's time frame. So it's just it's essentially using very short-term momentum to identify stocks that are moving that you may want to trade on your own. So the 10 is just trade ideas for people who want more short-term trade ideas. The momentum portfolio is I'm planning to hold those from anywhere from 4 weeks or potentially longer if we have a stock that's in a significant uptrend. So that momentum portfolio is looking at the impact of momentum over a longer series of time frames, coupled with the fundamentals of earnings and growth. The 10 is simply looking at momentum as price action. So it's not accounting for fundamentals, excuse me, fun with mentals, take your choice. It's not focusing on that end of the spectrum. It's strictly the 10 is just what's moving today. Excuse me, what's moving this week. We'll get that one updated at the end of this week as Jeff returns from personal business. So and I'll make sure to keep you with a clear distinction between the two inside of the AI2 Insiders program. So again, that's for people who want. Think of it this way: the 10 is for people who want day trades to multi-day trades. The momentum portfolio, we want big percentage gains, right? We're looking for 18 to 22% from that portfolio over the next 30 days. That's the difference between the two. Yeah, I mean, right. Remember GLW all the time. And then all of a sudden, you can, I mean, even in this period right here in the I mean, subtract out that because that's ugly. Actually, just subtract out all of that. But I mean, this is a perpetual income type stock, right? Given all kinds of other factors that I won't get into, but selling puts, if you get assigned, flip, sell calls, take the money, sell puts, etc. This is uh, a little heavy on the up range for me. So I would still expect to see Corning come back down, retest somewhere between the 75 and 80 levels here, build a base, right? Like it did, if you go back to, it built a really nice base here in the June, July period. And then that extended slightly into August. And then earnings, boom, big earnings move, built another base, right? So, and then everybody came in and bought here. So I pointed this one out to Dave yesterday. I know it's on the list, but it hasn't necessarily hit all of his metrics for trading. But there's a trade idea to work with for those of you who are on the option side. So, all right, let me stop the recording here and off we go. I will be back on